Good afternoon, everybody. Welcome to TraderMerlin Show. It is your Monday edition. Time flies when you do one show last week. Hope you all are doing well. I feel like off-center today. I have to get my camera all straightened out. Anyway, it is the 12th of August, and last week on the show, several of you have asked about the carry trade and the unwinding of the carry trade. What does it all mean? Well, I think over the years, we've talked about the carry trade quite a bit and kind of how it's a no-brainer trade, particularly for those who have access to international markets. It's really a very, very, very simple way to make, we'll just say, very low-risk trades. However, nothing is risk-free, and what's happened with that carry trade, as we've discussed, I've mentioned this several times over the last couple of years, is that the interest rates in Japan are going to rise. They are going to increase. There's no way they could keep it at negative 0.1 for as long as they did without any problems. And we've been saying this repeatedly on the show. It's about time they start raising. And of course, over the past couple of months, we've seen them raise multiple times. Went from negative 0.1 to a positive 0.1 and now up to 25 basis points, which of course is causing that Japanese yen to surge up in value as more people are looking to buy the yen. But it's also creating absolute havoc for those that have been doing what is called the carry trade. So let's start things off today by talking about what that carry trade is. Now, the carry trade can be done amongst many different currencies. However, we're going to focus on what's called the yen carry trade. Now, how does it all work? Well, it's actually really simple. It's basically buying one thing at a very low rate and essentially using that money somewhere else and getting a better rate. I know it seems very simple, and it will be when I show you the graphics here that I hopefully don't have any mistakes because I slammed them together here very quickly. Essentially, this is it in two sentences. You borrow low interest currencies and you buy higher interest rates. So to make that kind of a little bit clearer and easier for you, here is going back to Forex Factory. Again, we've referenced this many times. This is the current bank rates for central banks around the world. And you can see right now New Zealand and the US dollar leading the charge at 5.5%. So at the bottom here, you have the Swiss franc, and you can do a carry trade with the Swiss franc as well. But essentially what these guys are doing is borrowing Japanese yen, because you could borrow it at what was zero. So for the example we'll look at here, let's say it was zero, but for the longest time it was negative 0.1. So essentially, you're borrowing the Japanese yen at zero. So you can borrow as much as you want at zero. And then you take that, you convert it into another currency, let's say the New Zealand dollar, either or, US dollar I'll use, and convert it to dollars. You could buy government treasuries if you want, whatever the central bank rates are, go for the shorter term stuff, and earn 5.5%. So essentially what you've got is 5.5% rate of return for free. And there are a couple risks which we'll address here in just a second, but it may not seem like a lot, for you and I that are maybe, got a $50,000, $100,000 to play with, making 5.5% per year on that is not the greatest, right? We could be doing better. However, when you're a hedge fund or a major financial firm, you're not doing this with $100,000. You're doing with billions, if not hundreds of millions of dollars. That is a pretty important part here, because somebody like BlackRock, somebody like a Goldman Sachs is going to go over, whether it's their own dealing desk or to banks in Japan, and say, listen, we'll borrow $10 billion worth of yen from you. I was okay, great. Bank says, sure, here you go. BlackRock will take that, what did I say, $10 billion worth of yen. They'll take that $10 billion and then they'll bring it back, convert it into US dollars, which has further caused our dollars to increase, because remember, they have to convert it. They're buying dollars. That drives the dollar price up. Not only that, they go and buy government treasuries short term, earn, let's say, 5.5%. So they're making 5.5% risk-free, but leveraged to a huge extent. And that's really where the risk comes in here. Now, do they have to buy U.S. bonds? No, you can buy whatever you want, but of course, you're going to try to take as little risk as possible. Therefore, they're probably going to go into bonds, which are a safer category. So let's go look at a visual here. I tried to graphically kind of create what it might look like. On the left, we've got let's call it the Bank of Japan or banks in Japan. And on the right-hand side, we have U.S. markets with U.S. banks. I know I'm doing this without David Warner. I know. Well, he should be on here, Ben. Call him up. Let's get him on. I'll do a last-minute appearance by David anytime. And let's say that you are in the middle here. Nicely parted hair as well. And for an individual consumer, it's probably not going to make a ton of money here, but let's just say this is an institution in the middle. They will go and borrow yen, take that yen, and then go and invest it in higher paying assets. Now that could easily go back into the Nikkei, but because of the struggling market over there, they will bring it most likely back to the US, where they can either buy bonds or the equity market is in a nice uptrend, as ours has been for quite some time. So most likely it's going to go into bonds. That's the safer play, but they can go into the equity markets, which a lot of people attribute the sell-off over the past couple weeks to the unraveling of this carry trade, which I'll explain here in just a second. And basically what they're doing is they're going to take that investment, earn some yield on it, take those earnings, and then pay the interest on that loan, which is zero. But ultimately they have to take those earnings and repay that borrowed unit. Okay, so that's the essence of the carry trade in a simple nutshell. Now, of course, along the way here, there's a lot of different risks, and I'll address the two main ones here. But I'll come up with a simple example, and I tried to do one with a little bit of math here to make it easy for you. But let's say, for example, you borrowed 1,000,000 yen on April 1st. So we can go over here, and I'll bring up the our markets for you and show you the yen. Bear with me. Here you go. Got all kinds of lines on here. So let's go back to April 1st. So we're looking at a shorter term loan here. And here, right where my vertical line is April 1st. Right? And right around then, you were looking at, I'm being generous, I said 151. I use 150 as the number. Okay? And when that happened, borrowed 1,000,000 yen on April 1st, and you're paying 0% interest on that. So basically, it's a free loan. And that was when it was at 150 yen to the dollar. Okay? So that 1,000,000 yen is essentially $6,666. All right? Don't worry, I'm skipping the ads. It's letting me skip them now, which is great. So $6,666 is exactly how much you'd be borrowing. So you'd take that $6,666, you would maybe go out and buy yourself some U.S. government bonds paying 5%. All right? So in this case, this individual is making a 5% rate of return for essentially very low risk. We're not going to say zero risk. That, of course, is never the case. There's always going to be some risk. But essentially, they are getting a 5% rate of return for free. At face value, this looks good, right? Why wouldn't more people do this? Well, typically, we don't have such huge discrepancies between interest rates amongst countries. Fortunately for big firms, hedge funds, etc., Japan has kept their rates at a ridiculously low rate for a long time, and that has made for a luxury, easy trade for big hedge funds. Because again, they're not using their money. They're borrowing large sums of money, so this is a very leveraged trade. And everything with leverage works fantastic if it's going in your favor, but the second that it doesn't go in your favor and the doo-doo hits the fan, that's when the problems arise. So you guys tell me, and unfortunately I have a longer delay on today's show, but what would you say are the risks to this, right? There's a couple real fundamental risks. Hey, Steve, good to see you. There's a couple of risks to the system. I'm curious what you guys think they might be. So if you're a hedge fund and you've borrowed yen at 0%, and now you've bought some U.S. government bonds at 5.5%, you've locked in on that. If you hold everything to maturity, you've locked in a 5.5% rate of return. Great. Okay, that's fantastic. Hey, Chris, good to see you. How does the Bank of Japan make their money when lending at 0% interest? They don't make money. They're not lending it out to make money, which has always been a weird one for me, which is why I've never really understood negative loans, like when the rates get below zero, like it was for the Japanese yen for a long time at negative 0.1. They're not making any money. And what they're doing is by keeping rates very long, they're literally forcing you to not save in their country. You can't buy government bonds and get yield. So what you're going to do is you're going to go out and buy in other countries. And from an economics perspective, I don't understand the logic of that on why you'd want to force your citizens to take their money out and put it into international markets. I know that when a government is trying to fuel an economy to get it back on its track, they'll lower the interest rates so much so that people won't keep savings. They'll actually go out and spend it because there's no real incentive to save. This is when the hedge funds close their doors too much. And Margaret, it could very easily lead to some. It hasn't been that dramatic, I don't think, of an unwinding, but let's look at the math to it as to what those problems are. So nobody mentioned what they thought the problems might be. Let me talk what the risks are. There's really two main risks here. Risk number one is that the Japanese yen starts rising. Because remember, in the initial example, I borrowed 1,000,000 yen. My obligation is I have to repay 1,000,000 yen. It doesn't matter what the price of the yen is at that moment in time. So remember, I've already locked in the example I showed you, when I converted my 1 million borrowed yen to dollars, it was at 150. Okay, so that was 6,666 bucks. But if that yen rises sharply and my dollar, when I convert back into yen, gets me a poor exchange rate, all of a sudden it may not be enough to cover the repayment of the loan. And that's what the unwinding is really what's happening right now. So first risk is the Japanese yen increases significantly. The other one might be that US yields start to fall. Now, of course, if you're locked into fixed rate bonds, that's no big deal. It's funny, years ago, I remember hearing people talking about the risk here would be of interest rates rising in Japan, and that's not really true. Interest rates rising in Japan, none of these guys are borrowing off of variable loans. You're not borrowing at zero with a variable mortgage or variable loan, right? You're locking in at zero. The thing that happens with yields in Japan rising, why that's a problem, is the yen becomes more desirable, and that would cause the yen to rise. So the interest rate's not the part that directly impacts. It's a secondary element which causes the value of the yen to rise. All right, so those are our two main problems there with this one. Now, let's go back and say, hey, we've got to repay that 1 million yen, and it's now August, right? So let's go back to this page here, and we will move this line over and say it's what did I say, August 5th? All right, so it's August 5th, using a little bit of extreme. Notice that the USD JPY has sold off pretty significantly from that point, right? That is, if you look at this price chart here, a decline of roughly somewhere around 4.95%. Well, that is going to translate to a loss because this individual, whoever took this loan in Japanese yen, now has to repay it. And on that date, August 5th, it was 144 yen to the dollar, which equals, oops, I took the number out. It was, there you go, $6,944 to repay the loan. But remember, the loan cost them $6,666, which means a net loss on this of $278 or 4.17%. This is not an atrocious rate of return, but the problem why we're seeing, I think, this pick up and why there's so much fear about the carry trade at this moment is because there's belief that the Japanese yen may rally even more. So this is the spot currency pair. So when you see this selling off like this on the right edge, that means the Japanese yen is actually gaining strength. The dollar is getting weaker. So we had a rate cut a couple weeks back. Now we're at 25 basis points. The question is, does Japan continue to raise? And that's a wild card for anybody who's done this carry trade. Because if you've done the carry trade and you think that the Japanese central bank is going to raise rates anymore, then you know that this yen is going to continue this trajectory, which will make your losses even more significant and their leverage significantly. So what's happening is, as this unwinding of the yen carry trade is, for the longest time, they've had this free, easy spigot of money that literally they're borrowing with super leveraged accounts, and they're just getting that 5.5% or 5% rate of return for free. Now, all of a sudden, those two mechanisms have broken. The yen is starting to surge up because the central bank is raising rates. And you're also seeing the U.S. market potentially start to lower rates in September. So you had this low floor and a high ceiling before, which is what you want for a carry trade. Now all of a sudden the floor is rising and the ceiling is dropping. That opportunity for the carry trade may be disappearing. Now I mentioned before that there are several other markets here. You could easily be doing a carry trade with the Swiss franc, which is probably a little bit more stable. Go with the Swiss franc and go with the US dollar, and you'd still be making 3.75% using that same basic strategy. So that's really what the carry trade is looking for these higher yielding interest rates, looking at the lowest ones here, borrowing on the low end, lending out on the high, or buying bonds at the higher rate to kind of lock in that safer rate of return, or as some of the more speculative markets have done, borrowing cheap and going and buying equities, which I wouldn't say to do. That's a little bit more risky. Now, this has all, again, worked out fine for quite some time, but now those dynamics are changing. And the potential could be that yen continues to rally, and if that does happen, that's going to hurt these hedge funds even more and anybody who borrowed. So there is this rush to the exits of let's sell those instruments that we bought, whether we bought bonds or we bought U.S. equities. Let's sell those instruments, cash out those, repay those loans real quick before the yen gets any worse and our losses get even deeper. Hey, Big Ab, good to see you. So I think Margaret, you were asking about. I think Lori was asking about that one as well. Does that help explain the yen carry trade and the unwinding of it? Personally, I don't think that we're done. It's another question that's come up: is do you think that we're done with the yen carry trade? And I don't. I think the unwinding is going to continue to happen. Although you look at the magnitude of this move here that happened starting on call it July 10th. Right, that was a pretty significant move to have a currency drop that much. Right, this is the U.S. dollar against the Japanese yen, and at one point we were down roughly 12.4% on that currency pair in 18 days. That's one of those moves that can evaporate funds, that can just cause you, if you're over leveraged and you're using that carry trade as your main source of trading, this one of those potential moves that could wipe out a hedge fund. Although I haven't heard about anybody getting completely zapped because of it, but certainly some hits coming. And that does coincide when you look at like the S&P. We have had a fairly decent sell-off, and I think that's a culmination of many things. I've been talking about how I felt these markets were somewhat overvalued, but you couldn't ignore the trend. Now we've broken that intermediate to shorter-term uptrend on the S&P, which I've got on your screen here. Right, we broke that little area of demand, which is right around 5,422, and now we're down below that. I think you may see further selling off here, albeit I don't think as strong. If we see a surprise rate increase from Japan, then yeah, this thing's going to have another big drop to the downside. But I think Japan's going to hold steady for a while. I will bring up for you here. Let me one quick moment here. I need to go find the Japanese yen numbers here just so I want to show you what that looks like over time. And that was actually back at the end of July. Yeah, come on, Merlin. I thought it was the end of July. Here we go. So here is the, so July 30th, day before I left, they did their rate increase. And here you can see, they now have all of a sudden started to, you see how flat they were for the longest time? This is negative 0.1. So this carry trade was literally a trade for these banks and hedge funds that for years was gravy train. And personally, I think this was a good amount of their profits as well. I think that they made a lot of money using leveraged money, borrowing yen with leveraged money, and just loving it. This may impact your financials over the next quarter, especially if this number continues to rise. But keep an idea, keep your eyes on this trajectory, right? So you had liftoff for the Bank of Japan happening in March of this year. They stayed stable for a few more months, March, April, May, June, and then all of a sudden July they raised again even more. This type of increase leads me to believe, just based off of historical precedent, that we're going to see further rate increases. That would be crazy. I think that the global community right now would be screaming at Japan, going, hold on a second, don't you frickin' raise again. Hold on, let us do damage control here before you raise again. I think that there's going to be banks that are just screaming mercy here, like, whoa, stop, because they have been way over leveraged. There's been no reason not to. It's been an easy almost risk-free trade if you're borrowing yen and buying government bonds. It's been fantastic for you. Now, let's look back. Let me see. We are due for in September, but I'm going to go back into July to look at our rate cut, which was on Wednesday. Let me find this one real quick. Always tough to go back and find the announcement dates. 1 second. It was the 17th. And here we are. Let's go to... Why am I not seeing it? I thought it was Wednesday the 17th. Oh, here, I'll let you watch so you don't have to stare at my ugly mug. Maybe I was wrong. Maybe it was right there. The 20... Yeah, so I got it wrong. Huh. Canada, overnight services. All right, well, let's just go to this page here, and I will show you through that one what the Fed funds look like, and then we'll go look at the next meeting date, which is September. I want to look at the percentage thoughts on U.S. Unfortunately, Japan doesn't have this type of, I haven't seen Japan with this type of analytics where you can kind of guess or anticipate what you think the rates are going to be. So right now, guys, there's a 51% chance of one rate cut, 25 basis points, and there's actually a 48% chance of 2 rate cuts. I think that would be really far-fetched in September. I don't think you'll see 50 basis points. But so let's go look at September 18th, which I have to go forward a couple months here, just so we can see the increase. And I want you to kind of notice what happens once central banks take liftoff. So we were here for, under right around 25 basis points for the longest time. And when we took liftoff was on March of 2022. And it was basically every meeting they kept raising and raising and raising and really went all the way through raising until they paused one meeting in June, and then they paused ever since. So I don't know. I look at what's going on with Japan as far as their rate increases, and it makes me feel like you're going to see more. 25 basis points seems incredibly low. Right now, the U.S. is at 5.5. When I showed you earlier, I already kind of closed it out. But you look at other central banks around the world, a lot of them are thinking cut rates, right? Cut rates and lower, and all of a sudden you've got Japan's over there going, no, we're raising. You're going the wrong way, Japan. But I've been saying that for a while. I just couldn't understand how Japan could stay there at negative 0.1 as the rest of the world was an aggressive raising to maybe stave off inflation. And that's a good question. I've always brought that up in my mind, and I don't know the answer to it. I think some of you may or have an idea on it. And that was, if you have money extremely cheap, which is what the U.S. did for quite some time, right? Our interest rates were near zero. And if you have money that cheap, the belief is that that's going to spur inflation. And the whole goal of having rates, near zero is to get people to spend, right? You want to stimulate the economy. You have to have your consumers spending. If they're going to be hoarding their money and saving it, then your economy is not going to grow. It sounds good on paper. I mean, I'm a saver. I'd rather save my money than spend it. I'm not contributing as much as some others to the global health of our economy because I don't spend as much. However, when rates are down near zero, that's their goal, is to get people to spend. Now all of a sudden you have our rates up at 5.5%. That starts to choke out the economy, starts to slow it down because, as you're noticing, it gets much more expensive to buy. And you're actually almost rewarded for saving by keeping your money in a savings account or going with bonds that'll give you 5.5% over the next 3 months. So this is all a strategic government move, in my opinion, and I still don't understand how Japan didn't get inflation from it. When we had our rates for that low for so long, let's look how long our rates were down that low. Here you go. From December of 2008, we were at 25 basis points or less, and that was in place for 6 years, almost 7 years. We were down at that rate, and of course, we started to see costs of goods and services rise. Of course, the real culprit for inflation, we know, was the Fed just printing trillions of dollars, $16-17 trillion in just a few months. That's really what did it. But this also does, spur economic growth. And in my opinion, they should not have kept this that low that long. I think that was a big mistake. They should have raised up earlier. But hey, what do I know? I'm just some schmuck with a 45-minute to an hour show every day on YouTube. Who cares? All right, let's see. This is when hedge fund, I don't know. On that Monday when the market dropped, the news kept saying it was the carry trade. Most people don't know what that is. Good explanation. Thanks, man. Yeah, and it was part of it. I think that was part of it. It wasn't the big cause, but I do think it was part of it. As they came out with their 25 basis point, increasing up to 25 basis points on their lending rate, now, or in their Fed funds rate, all of a sudden, repayment in yen is going to be much harder. And again, I reiterate, if we continue to see this Japanese yen chart look like this, and this keeps on drifting lower and lower, I expect more pain for the equity markets. It makes sense to me that you'll see, if this does continue down, like I have that little arrow drawn there, or a little line drawn, that would certainly put a lot more downward pressure on the equity market. So I've got a bunch of puts that I've sold at lower levels, which I'm okay with. They all expire this Friday, and we'll reevaluate. But I'd be a little careful going out longer term and kind of anticipating what might be out there in 3 to 6 months. Who knows? This is definitely a wild card that, look at the trend here we had. Oops, sorry, I'm not even over playing with my beard, not showing you the charts. If we have this chart right here, I think you got a lot more pain. But, look here. You just go back a month, and we were singing a different song, right? I think we were all singing the song of, hey, go to Japan. The U.S. dollar is buying you more and more and more and more. I mean, the value of your buck was just off the charts. And I'm regretting that I didn't go. I would love to have gone to Japan. I made that mistake. I missed that opportunity. But now you look at how much that yen has dropped over just the past couple of weeks. A lot of opportunity missed, a lot of traveling for me that will not happen because I won't be going to Japan now. Based off where we are today, you're looking at a 10% slide in the Japanese yen. 10% gain in the Japanese yen, 10% loss in the U.S. dollar's purchasing power just in a matter of a couple of weeks, so almost a month. All right, so that's your carry trade. I don't think it's over. I think a bulk of it is over. The problem we have with the carry trade is people don't know how much it is. This is not a transparent calculation that you can just look at and go, oh, well, that's how big it is. Oh, this is how big it is. No one really knows. I'm hearing estimates from the hundreds of billions up to the $1 trillion mark. $1 trillion of this. So you can imagine if it's $1 trillion and that carry trade, just from, let's say, from April to August, dropped over 4%, that's $4 billion. That loss is coming from somewhere, and it could have been even worse depending on what the timing was when people actually locked in these loans. But, that's kind of shame on the trader, because as this market kept getting hotter and hotter and hotter, and the yen kept getting weaker and weaker and weaker, it was pretty clear there was going to be some intervention. Not to toot our own horn, but I think everybody in here as well, wasn't just me, but several of you, when we look back over here at the yen at 151, a lot of us are going, they're going to intervene soon. They're going to intervene. They have to. They can't let this happen. And, we got to the 160, and all of a sudden, boom, intervention. So we were pretty close to that one, but, the writing was on the wall. So I think anybody who was in that carry trade should have been lightening their load earlier, anticipating this coming, because there's just no way that gravy train is going to last for, 20, 30 years. And you can just pick it off and get easy money like that. But hey, get back to vacation, Big Ab. Have a good time. Are you North Shore, South Shore? My old stomping ground used to be Truckee, but I was really wanting to buy in South Shore. I like the South Shore side of things. But yeah, with all the Airbnb problems up there, I decided not to do it. But hope you have a great vacation, my friend. Besides government bonds, where else would they put that money to work? Equities. Yeah, equities, Margaret. Equities, absolutely. The belief was, and again, this is one of those things where you kind of don't know, right? Because you and I aren't going to see into the dark cauldron of what's inside of a hedge fund. But they're probably investing in equities, right? And a lot of this kind of, it's not fabricated money, but it's borrowing money from one country in mass to the tunes of $1 trillion potentially, converting that to dollars, which has caused our US dollar to rise, right? I mean, here's the US dollar. You can see it's been rising as people are borrowing yen and buying dollars. I mean, we've had a great move up. But then they've also been buying equities with it. And look what's gone on in the equity market. So the unwinding of this trade could cause these markets to come down considerably more, because you have multiple factors at work here. Number one is, consider the rally in our equity markets may have been fueled, not entirely, but one of the major catalysts may have been the conversion of yen into dollars, buying the equity market, because the tech market was unstoppable at that time. If that yen carry trade dries up and becomes non-event, then you have to sell those equities to repay those bonds, or to repay those loans, and that sells off the equity markets further. That said, what's it going to do to the US dollar? Well, if people were selling yen to buy dollars, and now they need to repay those loans, they have to sell dollars to buy yen. So this may be one of those things where anyone who was overtly bullish on the dollar, I'm raising my hand right now because I've definitely been very bullish on the dollar. To me, it does speak to the US dollar potentially dropping even more. So here is the dollar index. And of course, this is the US dollar versus a basket of securities. We've talked about this one where I don't see any real dominant direction on the long-term chart here. So here's your dollar index. But what I am seeing, not long-term, but just over the past, let's say 4 or 5 months, is lower lows, lower highs, which means it looks to me like this dollar is going to start getting weaker and weaker. And that may have a large component of it is dollars being sold to repay Japanese loans. That's the unwinding of the carry trade. So based off that, I would anticipate further trickle down here, sell-off of the dollar. So play that how you want. A weak dollar may actually be bullish for the markets, but remember, markets may need to be sold also to make repayments for these Japanese loans. So there's a lot of intertwined pieces here for this carry trade, and it is a major thing. This isn't kind of a minor, oh, well, it's okay, it'll be fine. This is a major event that could have much bigger impacts on our markets, which, that, my friends, is the carry trade, or I should have called it the unwinding of the carry trade. But, no, there you go. You see these happen. I think the last time was probably, 2000, I think 2010 or 11 was the last time we saw that carry trade unravel for the Japanese yen, US dollar as well. So these trades come around every now and again, and it doesn't have to be the Japanese yen. The Japanese yen is just one that likes to stick around zero sometimes and makes it really easy as one of the pairs of that carry trade. Okay, let's see. Let's see. A repeat of LTCM kind of failure from the unwinding. Oh, I don't know LTCM, but it could and Steve, this is what will be interesting over the next couple weeks is, do we start hearing about hedge funds that blew up? Because I'm sure there's some hedge funds out there that are leveraged to the hundreds of billions of dollars, way more than they should be from a leverage perspective, and got stung. Now, this was nowhere near as bad as what happened with the Swiss franc when they unpegged their currency to gold. Okay, that pales in comparison. But there is definitely some pain that came about from anybody who was in that carry trade. It wasn't dramatic. It wasn't like, oh, they lost 100% unless they were way over leveraged, which that could have happened as well. They can trade arbitrage Russian debt. No, a little bit before my time. My real knowledge of markets started. Oh, cool, Big Eb. Enjoy the South. God, I love the South part. Yeah, my love of financial markets really started in 1996. So. Oh, and Michael, you kill me, brother. You kill me. I don't like Huntington Bank shares. So I'll explain why in just a second. So for anybody that want to know carry trade, hopefully I answered your questions on what it is, its magnitude. It's not something that's like it's a small factor. This is a pretty significant piece that ties into so many different markets because you've got currency markets, you've got bond markets, and you have equity markets all intertwined in a carry trade. The lack of transparency is what bothers me because I don't know how much of this Japanese yen has been sold to buy US dollars. Is it 100 billion? Is it 500 billion? Is it $1 trillion worth? I mean, the numbers do impact what the end result will be. And if it's $1 trillion, which is some of the numbers I'm seeing, is like, oh man, this could be real bad. I mean, we could see much more pain here. If it's a couple $100 billion, I don't think it's that big of a deal. But you get into the T's, now we're talking some big damage. And we don't know, did it go directly into treasuries? Is it in longer term bonds? Is it in equities, right? I don't know where that money has gone, but I think when we look at the price charts, it's pretty clear that something has been the catalyst, particularly for our equity markets. You know, everyone's like, oh, it's tech. Yeah, sure, it's tech, but something has to have been pouring into this market since November or October of last year. And we've just got a monstrous rally in the S&P going back to the 23rd of October last year. You're talking 40%, almost 40% up in the S&P. That's beyond normal, right? That is not a normal rate of return in under a year. That's phenomenal, although I think we're going to give some of that back here shortly. And then you look at tech, which is even more significant than that, going back to those same dates back here in 2023 to 47% pop for the NASDAQ. And about time there's some profit taking. I mean, yeah, I definitely think there's some profit taking coming in. Okay, 5 Acre Fire last night in Truckee behind the Safeway. Oh man, I grew up at that place. Truckee, one of the first place I bought was actually in Lake Tahoe, Truckee. I wish I never sold it. That's one of the big regrets I have. Love that place up there. All right, let's go to Anthony's question real quick here about Huntington Bank shares. So when we had our financial crisis a year or so ago, one of the big concerns that was out there was regional banks, which is like Huntington Bank shares, HBAN. And in a lot of my research, and it was a long time ago, but in my research, Huntington Bank shares had a lot of exposure to commercial real estate. And I still am concerned about the commercial real estate sector. I don't think that is done. I think that you look at something like San Francisco with a lot of vacancies. I think COVID destroyed commercial real estate because it made every IT manager realize, hey, we don't need an office. Everyone can work from home, and I'll just connect them to our servers and all our information. So there's a lot of building vacancies, not just San Francisco, which I think is probably one of the hardest hit areas because of COVID, because of the tech move, but also because of poorly run city government and just what they're doing up there in San Francisco. But other parts of the United States as well has commercial real estate problems. And a lot of those loans are coming due. I heard about a lot of chatter about extended defaults, like higher levels of defaults for commercial real estate. And if Huntington Bank shares actually has exposure to the levels of what I was reading, then I wouldn't want to touch it. Even though I got to give it to you, Michael, this is one of the first charts that you've shown me. One of the first charts that you brought up that actually is in an uptrend. I feel like we're making progress, brother. We're making progress. You got higher highs, higher lows. Technically, this looks good, but if you're going to go into it, I would be careful. You know, their earnings numbers could be hit here, although I don't follow them or their earnings, but the commercial real estate is just a wild card that I don't know enough about. It's not my area of expertise. But when I was researching during the financial crisis, I think actually, did I delete all those banks? Yeah, I used to have the banking sector on here, and I took it all off. But I had the entire XL, F ETF components, and Huntington Bancshares is just one that kind of makes me a little nervous. Don't know if I trust it. Kind of fearful about that one. Okay, guys, let me know what other questions you guys have. That was the main piece. I wanted to make sure I got to the carry trade. Hopefully you understand that one a little bit more. Now, there was a question that came through. I think I saw it. For some reason, hey, Tomasino's here. You missed Friday. Let's see. Lisa, hope I got my email regarding Bitcoin question involving BlackRock. I didn't get it because I just been so busy. I taught a class this morning. I'm just toast. But I did look at the question. And Lisa's question, let me quickly, was... there is speculation that BlackRock is now controlling and manipulating Bitcoin. I was wondering how that could be, and what is your thought based on on my extensive knowledge? They could certainly, can they manipulate the price of Bitcoin? And I think that they can, but the more that time goes on, the more dispersed ownership of Bitcoin becomes, meaning more and more people are going to be holding it, and there'll be less influence from one institution. Because of what's going on with the ETFs and the massive inflows into IBIT, which is the leading spot Bitcoin ETF, they do now have a significant amount of Bitcoin under their control. Now, could they be using Coinbase to manipulate that? And the answer is yes. And I do believe that there's some shenanigans going on there. I do think that there's manipulation of price. I don't trust BlackRock. I don't trust Coinbase. I don't trust the relationship between those two. So... did I hear about the M news? I did not hear about the M news. I don't know about the M news. Buying up all the Bitcoin, that's why, and ETF. So there is always the potential for them to manipulate. They could easily use their liquidity at Coinbase. Basically, they have power now because they have so much Bitcoin. They can sell in a big tranche whenever they want and buy it back. So theoretically, BlackRock could, at any moment, sell at market 100,000 Bitcoin. And for anybody who knows stock, 100,000 is nothing. But if you look at Bitcoin, you sell 100,000 Bitcoin, you're crashing price. You're crashing price. Now what they could do is they could easily dump Bitcoin like that, cause a big spike down, which causes panic and more people to sell, and then they'll buy back at lower prices. The interesting thing about that, in my opinion, is I think that Bitcoin holders are different. Big Eb's not watching because he's on vacation, and you shouldn't listen, Big Eb. Go, have fun, enjoy your time up there. But Big Eb is like me and several others in this chat, which means we are hodlers. So if Bitcoin were to drop 50% tonight, not only would my pulse not rise, I wouldn't get flushed or excited or anything. I may actually start thinking about buying more Bitcoin. Now, if I was in Apple shares, and Apple shares ended up dropping 50%, I might be panicked and forced to sell. But it's different, I think, in crypto. You have people with a different mindset. I don't feel like that type of manipulation game, which happens all the time in the equity markets, I don't think it's as prevalent in crypto. I think that there's plenty of manipulation for another reason, and that's not to panic me or you out of your position. It's to trigger stops. So let me see real quick if I can bring this up for you. Hold on a sec. See if this site has it. How do you manage your time to do so much? What tools do you use? I'm scattered, Rob. Sometimes I wonder how I take care of everything that I do. I don't use any tools. I'll go over here to liquidations. And unfortunately, this does not give me Bitcoin. I wish it did. Yeah, there's no Bitcoin on this one because Bitcoin's technically not a DeFi project. But I know it might be hard for some of you guys to see. I'll try to make it bigger. But if you look out here at Ethereum, you see this table off to the right-hand side. And this table represents what's called liquidation. Now, right now, Ethereum is up at 26,000. These represent liquidation prices. So people have borrowed against accounts, and they're leveraging, trying to get more firepower by using leveraging. So what we could deem, if we were something like BlackRock, I know that if I could get price down to, let's say, what's this number right here, to $1,963. If I can get it to $1,962, I will force liquidate these people. Meaning they're literally going to be forced by their lender to automatically close that position. There's nothing they can do about it. So all I'd have to do is push price down to 19,000, and I know I'm going to get an instant volume spike of sellers on the market, and that's going to cause price to drop even more. So these little bars here represent points that hedge funds or arbitrage traders or just market individuals can target because they know that people have borrowed at those moments in time. And if it gets past there, they're forced to sell, right? You have these collateralized loans in cryptocurrency where I could deposit my Ethereum and start borrowing money against my Ethereum, literally leveraging my own trades. That's DeFi for you. But there is, when you open those trades up, there is what's called a liquidation price, which says if it gets to here, snap the fingers, your account will be vaporized. All that will be sold instantly. And it's transparent because we're dealing with blockchain and smart contracts, which are transparent and everybody can see them. So, these types of platforms, there's actually more out there. This is just one easy one. But there are some people that actually have lending on Bitcoin. And we could potentially put Bitcoin on here and see where their liquidation prices are. These perpetual futures products as well are products where there are liquidation lines. And somebody like BlackRock, I'll be honest, if I was a big firm like BlackRock, I'd be doing this all day long. I would literally have my trading department connected to exchanges like KuCoin, Huobi, BitMEX, and see where their liquidation prices are and be like, oh yeah, watch this. I'd snap the fingers, unload 50,000 Bitcoin at market, crash Bitcoin, trigger all those people to sell, which would instantly cause a sharper decline in the market. And then as it dropped even more, boom, I'd buy back in, push prices right back up where they were. And basically what I've done is I've liquidated the market. And this happens all the time. When you have a really big sell-off in crypto, follow the analytics platforms and they'll tell you, oh, here's how much was liquidated today, because people targeted those people. How they push down price, Merlin? Well, put out false. And yeah, well, of course, it's false. It's a false narrative, but if you want this is horrible, but if you want the best seat in a crowded movie theater, what do? You start yelling fire, even though there's not one. Right? People freak out. They get, oh, look at this perfect spot right here where I want it to be. This is nothing new. For those of you who might be kind of new to the markets, I highly encourage you to watch the Jim Cramer manipulation video on YouTube. We'll put it in the chat here for you guys. I think it should be day one of your financial education. Should be Jim Cramer manipulation video. And just you understand that these guys are lying. They're lying regularly, they're cheating, and they're trying to influence what you do through fake news, through fake information. Can you borrow against Bitcoin? Yes, you can. Yep. So I just put in a chat a link to this interview. This is Jim Cramer explaining how the market manipulates prices. And it's funny because he's like, oh, I wouldn't do that, which clearly he did, right? This is definitely what he did in a hedge fund. And he says, I did this in a hedge fund. He calls the SEC bozos, etc. Anyway, here's a commercial. All right, so don't watch that one now. Watch it at a later time. But for all of you, if you've never seen it, please just watch that video. It's one you'll literally, your jaw will hang and you're like, I can't believe that guy said that. Just so you know, the video that I'm referencing, Jim Cramer was under the impression that this was behind a paywall and was only for fund managers. This was not supposed to be released to the public. So this is kind of the Wizard of Oz type thing where I think he was being honest, and hats off to him for being honest, but it makes you realize that you should not trust anything that you see or hear in the market, right? Michael A here, who's usually with us. Michael, you love listening to news. You love listening to CNBC. You mentioned that the CEO of Huntington Bankshares was on Jim Cramer's channel. That's all bullshit. That's all manipulation, man. Do you think that the CEO of Huntington Bank Shares is going to get on Jim Cramer and be like, hey, Jim, my company sucks, man. We're missing quarter over quarter. You know, things are really bad. I think I'm going to quit. I can't take it. No way in hell. It's roses and blue skies. My company's doing great. We're investing for the long haul. It is all manipulation. So I learned early on back in 1998 that whenever I see someone on TV, I just think liar. And I'm better for it. Now, their company may be great. They may be doing what they say they're going to do, but I still don't trust them. The chart is what tells me they're doing what they're saying they're doing. All right, that's the only part that matters. So yeah, don't fall victim to it. I believe that this is one massively manipulated game in favor of the giant firms, and I don't think it's an impossible game for us to compete with it. I just think we have to understand our role. You and I'm going to speak for myself. And I know some of you, because you're smaller fish. I will never be the market mover. I will never be the one who is forcing stocks in a different direction because I've got billions of dollars worth of firepower. It will never be me, and I know my role. I have no delusions of grandeur. My role is to be literally a mosquito in this giant forest and jungle of savage killers. Gorillas, alligators, elephants, rhinoceros. Those are all animals that are way bigger and tougher than me. My role is a mosquito. I want to ride on the back of those guys, draw a little blood, and get out before they even know I was there. That's our role. So don't think you're going to be a Goldman Sachs, boxer and knock them out. It ain't going to happen. No way. You just don't have the resources, don't have the firepower, you don't have the connections, and not to make you feel little, but we are little. So don't give yourself any false hopes that you're going to be better than these guys. You're not. Our goal is to pull enough money out that makes us happy and allows you to achieve your goals. That's really what it's all about. What did Ricardo say? CEOs and CFOs perfume? Yes, they do. Yes, they do. Okay, I'm going to wrap up here. Let me go into our economic calendar since I'm way off on the day. But let's go back to today and show you what's coming up for tomorrow. Mañana. Mañana's going to be a good day. We got some good, exciting stuff coming out tomorrow. Here is your economic calendar. Boom. The big thing for tomorrow is going to be before the markets open. And expectations are right now they're going to see producer price index stay right where it's at, 0.2%. I'll show you the table here so you can kind of see what that looks like. Here is what CPI or PPI has been doing. It was on a nice little downtrend. The most recent number was higher than expectations, but we'll see how that ultimately pans out. So 0.2% we're expected to stay at right where we were the previous meeting. That is your big news. Any deviation from that is going to cause huge swings in the market. Now, you also have a rate announcement coming out tomorrow night, which will be after we do the show, so that's fine. We'll talk about tomorrow. That's going to be for New Zealand, but we'll bring that up when we're on tomorrow's show. So really, for tomorrow, it's just the U.S. markets with the PPI numbers, the core PPI, and 1 hour before the equity markets open. If you're trading the euro at the wee hours of the morning, you're going to have some volatility in the euro because of the ZEW economic sentiment report. It has not been looking atrociously bad. You can see here, got 0 as your neutral line. It's been actually looking pretty good. You can see that their economic sentiment is showing more and more positive growth. It seems like every month it just gets better and better and better. But let's go zoom out long term so you can kind of see it. All things seem to be looking pretty good, at least from the economic sentiment report. That is for the European Union. And then you have Germany by itself, which is here, also looking very good. Earnings-wise for tomorrow, I don't think there was anything. There was Barrick Gold was today, but the good stuff really comes out tomorrow. So that, my friends, is your carry trade, the yen carry trade, and really any carry trade. It's an interest rate arbitrage game that's used by the big money, the hedge funds, etc. And it is a very lucrative game until it's not. As we say here frequently, everything works until it doesn't. And this is one of those moments where those hedge funds may have got caught with their pants down and got kicked in the teeth a little bit. We'll see how bad it is over the coming months. If Japan continues to raise, I think this damage could get a bunch worse. It would certainly put me in the side of err on caution and potentially look for... I'm not really looking for any big upside moves here. I think we'll probably see a slow trickle down. Oh, you wanted Ireland picks. Okay, tomorrow I'll show you some Ireland picks, okay? Steve says, top shelf liquor for free, unicorns, and nobody gets older sick of trusting. That's how it feels sometimes, doesn't it? All right, I'm going to get out of here before you guys get a commercial. I've censored almost all your commercials today, so enjoy that. Anyway, thanks, guys. If you have anything you want me to talk about tomorrow, I will do Ireland picks tomorrow as well. You can email me at tradermerlin@gmail.com. Take care, everybody. I will see you mañana.